Hello, real estate investing fools. Welcome to this replay of a Millionacres hour that we did recently, where we discussed all things real estate investing with Matt DiLallo and Aaron Halfacre, who is the CEO of Modiv. He's in charge of strategy and business development. He's got an over 25-year track record in the industry, and he's been involved with over $12 billion in capital market transactions. He held positions at Realty Mogul, Campus Crest, BlackRock, and Green Street, and is just a fantastic resource. So please enjoy the show. So I'm here with Matt DiLallo today, who has written a lot of our real estate crowdfunding reviews. And we're proud to welcome Aaron Halfacre, who is the CEO of Modiv. He's in charge of strategy and business growth. He's got this massive 25-year track record in the industry.
Hey, everybody. I'm Matt DiLallo. I'm one of the writers here at Millionacres. And one of the tasks that I've been really interested to follow is crowdfunding. And I was able to do a lot of the reviews for all the crowdfunding platforms. And one of them is Modiv. And as a company that I personally invest in, I've just been really interested in real estate investing outside of the stock market. So you can invest in REITs and home builders and that sort of thing. But I just wanted something outside the stock market. And that's where private real estate fits in. So one of the companies that I came across during that time, it was called Rich Uncles at that time, but they since changed their name to Modiv. And it's really interesting. And I've really been excited to get to know Aaron and his team. And so, Aaron, why don't you tell us a little bit about Modiv and what makes you guys different?
Sure, Matt. Appreciate you having me on board. Deidre, pleasure to meet your acquaintance. So Modiv, as you mentioned, acquired the Rich Uncles platform in its prior legacy. And Modiv is a lot of things, and they're all applicable. So if I told you that we were a seasoned real estate team that is an investment manager, that would be accurate. If I told you that we're a real estate crowdfunding company that's also acquired other real estate crowdfunding companies, that would be accurate. If I told you that we are a $400 million portfolio of single tenant assets that elects a REIT status, that would be accurate. And so we're all these things. And so we cross a lot of different industries. We cross the non-traded REIT space. We cross the crowdfunded space. We're unlike any other opportunity out there in the sense that we are all those things. But it's a little bit nebulous to describe Modiv at the end of the day. But we're designed for people who want exposure to that private real estate that you talked about, who want growth and income. So not just growth. And we pay a monthly dividend, Modiv. That's kind of what we do.
So just tell us a little bit about how it works and why is it an option compared to publicly traded REITs?
I get the question a lot. So if you guys are a REIT, why should I invest in you versus a publicly traded REIT? And my answer has always been, look, I came from over a decade at BlackRock. I worked at Green Street, which was one of the premier REIT research firms. I've always been sort of ensconced in the real estate capital markets, both public and private. And my answer to anyone who asks that is, I actually think you should have exposure to both, because they exhibit different price behaviors, right? So if I am a publicly traded REIT, oftentimes I'm a mid-cap name, right? So if I'm a mid-cap name, I'm gonna get picked up by ETFs and indices that could be the Russell 2000 or something like that. And so I'm going to have trading constituents, sort of buyers and sellers of that stock, who don't care about real estate, but they're buying a index. So you're going to have price volatility in a publicly traded one that is different, right? You're obviously going to have enhanced liquidity in a publicly traded one, assuming the markets are coherent. On a private one, you're getting just the real estate price of the assets. So in our case, we have Cushman & Wakefield, which is a nationally recognized valuation agent. They go and appraise our assets every quarter. So every quarter we release an NAV, or a net asset value. It's not a stock price, because it's not decided by supply and demand of buyers and sellers. It's really determined by the value of the real estate. So our real estate values are going to be reflective of actual real estate pricing, whereas a publicly traded REIT could be reflective of fear and contagion about coronavirus, or the Fed interest rates, or whatever happens to be in the news that day in the market. So I think they're complementary. If you look at sort of pension plans and sovereign wealth funds, they tend to have allocations to both.
Yeah, I know personally, one of the things that drew me to crowdfunding was just that opportunity to get outside of the stock market, because a lot of REITs will just trade with the stock market. And then, as you mentioned, net asset value, I noticed I was particularly interested, for example, in apartment REITs. And at one point I was looking at them, they just seem to trade much higher than I would have, paid if I was buying an apartment complex. And so with non-traded REITs, a lot of times you get that actual value. So that was one of the things that drew me to it. But one of the I really think that's interesting about Modiv is you've got that real estate platform, that crowdfunding, and that just makes you unique in how you draw capital. For example, people can log onto your website and buy stock. Can you tell us a little bit about why that platform works for you guys as opposed to being publicly traded? And then you mentioned some of the the fintech and prop tech. Explain a little bit about more of that, how that makes you guys different.
Sure, absolutely. So if you think about publicly traded REITs, we know them and see them now as public securities, but for the most part, every one of them started out as a private portfolio, right? Because it takes the aggregation of the real estate assets and the capital before it gets to enough size that then you choose to list, right? And so if you look at like Simon, right? So Simon was a family's portfolio of retail shopping centers and apartments, and they got rid of their apartments and they went into malls, and then they eventually got big enough and they listed, right? So if you look at the history of almost every publicly traded REIT, it started out as a private portfolio. Now, how those portfolios are raised is interesting. Historically, it was either, they would go sort of the country club sort of thing where they'd go to they're accredited investors, and they'd do a series of raises for Reg D private placements, and they would buy assets and they would cobble them together in a portfolio, and eventually they got the size and scale. Back in the 90s, late 90s and early 2000s, what you started to see were the non-traded REIT portfolios. So these were sponsors that would launch non-traded REITs, so they're public filing but not listed, and they would sell them to the broker-dealer community, so the LPLs and the Ameriprises. And then they would raise capital that way and aggregate up large sums. Many of the REITs that we see today had their genesis in that form. The conundrum with that non-traded REIT format, as if anyone's done the history, is that there was a lot of investor abuse. And what I mean by that is there were, 7% upfront commissions and a lot of intercompany dealings where, they would form their own asset management company, their own brokerage services, and they were just paying themselves a bunch of fees because the manager of the REIT was externally managed. And that meant that they were a hired gun to manage that portfolio. If you look at the modern REIT era since 1992 and up, the vast majority, and certainly like 99% of the REITs, or any of those that are favorable on the publicly traded side, they're internally managed, so that the CEO and the CFO and all the employees work for the REIT. They don't work for an external advisor who gets paid a fee. In fact, externally managed REITs that are public are frowned upon, and they usually trade at discounts. So going back to this point of how does the crowdfunding platform work for us, we've been able to raise over $250 million of equity into a single REIT portfolio without paying any intermediaries. There's been no commissions paid. And so the investor, just like to your point, just come online, they make their investment, they get qualified, we sell through a FINRA broker dealer. So we're level set against every sort of FINRA registered type of product. But we eliminated all those costs. Now technology helps to do that, certainly, but now allows us to aggregate that portfolio. Instead of $1 going into, so right now, you spend $1, it goes into a dollar's worth of real estate. The old days, the non-traded days, you'd spend $1 and about 85 cents went into real estate. And so I think that's the reason why we like it. That's why we also think why crowdfunding is going to continue in its demand. We think that crowdfunding as a microcosm is advancing real estate capital markets, right? So the interplay between real estate and the people's access to capital. And so the fintech, prop tech investments we've made have been along those lines. Are these technology companies that are advancing real estate capital markets? Is it finding better ways to facilitate more efficient pricing, more efficient price discovery, more efficient use of capital being matched to properties? Because if that happens on a grander scale, we're going to see more and more efficient pricing in real estate and greater acceptance as an asset class. Obviously, it's a huge asset class, as we know, but heretofore, it's still been relatively limited, certainly the commercial aspect of it, by individual investors. And we think that the technology interplay between real estate is a way for investors to increasingly get exposure.
Well, let's talk a little bit about that because you mentioned REITs and we saw, sort of through history how REITs developed and became accepted by investors. Real estate crowdfunding, obviously very early days. We saw some changes last year on accreditation and what's required. What other changes do you think are going to come in real estate crowdfunding, and how does the industry itself kind of need to improve as it grows up?
Yeah, that's a great question. I've actually gotten a question quite a bit lately. Is do you think the SEC should or will lower the accreditation standard as a mechanism to try to provide access? My view might be controversial, but I actually view the accredited investor standard that the SEC originally established was ideally suited toward Reg D or private placements. A lot of times these Reg D or private placements are high risk. They might have full speculation. They could be a development deal, could have very little income. And that is, true at-risk capital. And that's not necessarily the traditional income producing type of real estate investment you do. And so if you're doing true at-risk capital, the standard should be high so you're not having abuse by the sponsors who are misleading investors. And you also want to make sure that those investors can afford to put that money at risk. The non-accredited standards, which allow people to come in as little as $500, have been relegated to the Reg A plus, right? And the Reg A plus, up until recently, was limited to $50 million in any 12-month period. Now it's been increased to 75. I think the direction that the SEC would be better served to doing is increasing the Reg A plus percentage or the dollar amount. So it's 100 or 120 or $150 million and leaving accredited investor status where it is. How does that work? As a Reg A plus vehicle, you have to file with the SEC. So you have to be public. You have at least semi-public. You have to have semi-annual filings. You have to do the equivalent of an 8K, which is called a 1K. So you're under SEC scrutiny. So if you're under SEC scrutiny, there's afforded better protections for the less sophisticated or less accredited investors, if you will. And so that there's better safe harbors and protections. By increasing the size of Reg A plus, more people can more sponsors will come in and offer products because they're not capped at $75 million. But it still allows the accredited investors threshold to be for those things that are speculative or esoteric. And it's appropriate where, you have to have a higher net worth or you have to have more sophistication being a, registered rep to go into those investments. So that's the kind of direction I think would be better served for the marketplace.
Interesting. Just a quick follow-up on that. Do you feel that it makes sense to have non-accredited investors invest in individual products, individual projects? Like for now, most of them are investing into larger pools of properties.
Yeah, so if you think about the real estate crowdfunding spaces in particular, I look at it as a spectrum. On one end of the spectrum, you have is what I call digital syndication, right? It's the same form of syndication we've seen time eternal. CrowdStreet best exemplifies this, right? So they're creating a two-sided marketplace and they're matching investors with sponsors and they're putting them together into these individual deals. At the other end of the spectrum, you have what are asset aggregators. So Modiv is an asset aggregator. So all the capital we raise, we own title to, we control it. We happen to control it in a single vehicle. Fundrise does it in multiple vehicles, right? But we're not selling individual properties. We're selling commingled portfolios. I think those business models will converge. And I think the convergence of those will allow for both accredited and non-accredited investors into it. I liken individual property deals to stock picking, right? So there are people who prefer to own a mutual fund and they want it commingled and they want someone to manage for it. And there's others who say, well, I might want a mutual fund, but I also want to overweight Apple or I want to underweight this. And so they buy the individual stocks. I think that's a behavioral finance sort of aspect, and that's never going to go away. And there's always going to be people who want to own individual assets. In fact, Modiv is getting ready to launch in the fourth quarter what we think is a blend of those two things. So it's a product that offers individual properties, but it's structured in a REIT on the back end and allows for, under Reg A, and allows for non-accredited investors to make investments in properties. The key we'll be doing though is it'll be income producing properties, right? So that you'll be buying a Walgreens or CVS or some sort of thing like that, where you own the economics of just that asset. And so you own the shares of just that asset, but it'll be Reg A. So allow for non-accredited.
I know personally, when I was looking at what opportunities there were crowdfunding, I was looking for something that replaced the idea of me going out and buying an apartment building. It sounded like such a great concept to be able to buy a stake in an apartment building, in my hometown or even somewhere else that I thought was an attractive market and not have to manage it. Because, I think that's one of the things that gets a lot of people, I don't want that, phone call about, there's an issue with the apartment building. So, but I always saw the accreditation rules as kind of, holding people back from that ability to get that. So it's interesting that you're going that direction. I'm excited to see that. Now, just kind of switching gears. So a lot of our investors, they're stock investors, they know about benchmarking. They look at, the S&P 500. This is, we're trying to beat the S&P 500. If you're going to get a, pick stocks, that's what you want to try to do. But private real estate investing is totally different. So how do you look about returns? What is Modiv looking for returns? How do you benchmark returns? And what should your investors kind of like be comfortable with?
Yeah, it's a really good question. And I think the adoption, I think I should start off by saying sort of the real estate crowdfunding and the private real estate space, in the space that we're working in right now, is pretty devoid of sort of benchmarking as a general practice. And I think the industry is a loss for that, because by establishing benchmarking, you have a better relative context, and so things get measured better in a better way, and then you'll generally find more acceptance. So if you think about, if you go to those crowdfunding sites, the syndication models, you tend, and by the way, those are not FINRA regulated models. So they're, if you're going to buy something from a Schwab or Fidelity or Vanguard as an example, they're FINRA regulated. So they have gotten their securities licenses, and they are very specific of how they can advertise and what they can say. Most of the crowdfunding space, there's a handful of us that are FINRA regulated, but most of them are not. And so what you see there is, when you're talking about performance, is this description of, here's a 18.25% IRR, and we think it's going to get a 2.15 equity multiple, and they project these. Now, FINRA doesn't allow you to do that. So that's why you won't see us ever do that. Those are forward-looking returns, and those are engineered and they're modeled, right? So I can go into Excel and I can give you any sort of output that if I want, because I can just manipulate the cells and get you variable outputs. And if you think about that, return is theoretically possible, as is a wide spectrum of return. We don't see, Vanguard or even Apple going out and saying, we think we're going to give you a 2 multiple next year and a 15% IRR. They don't, past performance is not indicative of future results. And we all know that. But that's why benchmarking is important. We don't have a ready benchmark, but I tell you what we do is we measure ourselves in a variety of ways. So we measure ourselves first and foremost by AFFO growth. So adjusted funds from operations, which is a measure of free cash flow, is what we measure ourselves against. So we make sure that we have a targeted AFFO and we're growing it, and we look for industry best practices. So we'll look at the AFFO metrics of a lot of publicly traded REITs, which most people who are just buying and selling stocks don't look at. They're looking at the share price. Again, we don't have a share price. We have a real estate price. So we can't control the metrics because it's fully independently appraised. We can control our FFO. We can control our G&A, how much revenue we generate, how efficient or profitable we are making our company. So that's one of our benchmarks. As sort of bellwether benchmarks, we look, because we're primarily single tenant net lease, we look to the net lease sector, publicly traded, to see how they're performing. But we also look at NCREIF. For those of your followers who aren't familiar, NCREIF is the National Council of Real Estate Investment Funds. And so the pension community, so the CalPERS and CalSTRS of the world, and a lot of sovereign wealth funds, they own private real estate, and they own it within what is called NCREIF. So NCREIF is an organization, a not-for-profit organization, that gathers all the real estate data and measures sort of unlevered private real estate returns. So we look at those as a benchmark too. How much income are those assets producing? What is their sort of quarterly change in NAV? And so we look at ourselves to juxtapose with that. That doesn't do the investor much good. At the end of the day, they have to rely on the acumens of our team and our expertise to manage that we're growing over time the NAV, we're growing over time the dividend, and we're growing the AFFO per share. So we're making ourselves more profitable.
Interesting. So what are you thinking right now in terms of different sectors? Obviously, office is a little bit concerning right now. Industrial is booming like crazy. What are you looking at?
Right now, we own single tenant office, single tenant industrial, and single tenant retail. Most of these are triple net. Some might be in double net. They're on long-term leases. So we don't necessarily have to worry about the conundrum of multi-tenant office, but I think it's an interesting thought process. I was at a conference last week on the East Coast, And it was a real estate panel. We were talking about, we had all had office in some way, or we'd all had touched office in some way. And what is the verdict of office, right? And I think you have to look at sort of major CBD office and then sort of secondary tertiary markets office. So downtown Manhattan or midtown Manhattan, probably more particular, people were saying, is this going to be doomsday? Will office prices just, be destroyed? I remember living in Manhattan after 9/11, and the pundits would say there was no one ever was going to reside in a high-rise office tower again. And within about 2.5 years, all the supply was absorbed, and we had pricing going up. I think what you'll see in sort of high demand sort of epicenters is that the density on the floor will reduce. So if you think about, the move was to open floor plans and packing more people in along these trading desk styles, that might shift away where we're starting to get more square footage per employee. But generally speaking, I'm finding, though we're a remote based company, and I know of a lot of people who have sort of moved to a hybrid model or remote work from home sort of model, there is still a need for collaboration. There's still a need periodically for a lot of these corporations to have people convene. I think what you could see is sort of a hub and spoke system. So if I were a technology company, or if I were some sort of service company, I might, instead of having a major headquarters where I spent, a gazillion dollars to build something in Northern California, I might have a bunch of regional leases in markets that I know my employees like to live. So Nashville or Austin or Denver, where I go and have space where they have built-in, IT infrastructure, so we can video conference, but they can collaborate and they can come in periodically. And then I can have, 5 or 10,000 square foot leased in 10 locations, and have people live in all these hip areas that they want to live in across the nation, and still have a lower real estate expense and real estate profile than I built my mega headquarters. So I think we'll see some of that. I think on the margin, certainly office pricing or rental demand is in an interesting time. Like, for instance, we always have lease renewals, and we have 2 office renewals. We just finished 1 office renewal. We have another one coming up, and it's a dance, right? We have a single tenant. They need this building. It's got like manufacturing in it or secured information facility. So it's mission critical to their thing, but there's still the dance of how much tenant improvements do I want to give them, or how much free rent do they want to get, or what's the lease term. And so if you multiply that on a multi-tenant basis, it gets really hard. And I think that the tenants or the potential tenants have all the pricing power when you have a traditional office building. So I think we'll see rents probably go down in the tertiary markets, but I think some of the poor, older quality assets will suffer, but I still think there'll be a demand. And I think we'll start to see office feels a little bit to me like strip centers and retail did about 3 years ago, right? Where everyone was like, I'm not touching those retail centers. Amazon's going to kill them. And now if you look at cap rates, a lot of those have come in, right? Industrial tends to be super hot. I think in some ways it's a little unrealistic. I mean, I've seen cap rates on Amazon industrial centers at sub 4 cap rates. I mean, that you're buying a 10-year bond at 375, which is better than a treasury, of course, but there's a lot of real estate risk if they don't renew, right? So I think it's an interesting space for sure. Other sectors that we like besides those, I think, multifamily we like, self-storage we like. Interesting enough, those have multi-tenancy, right? So self-storage has hundreds of tenants, but they don't know each other. They don't communicate. They can't sort of coalesce and give you pricing power, right? Whereas a bunch of office tenants can sort of say, well, this is the market. We are not going to move in here unless you give us X, Y, Z. Self-storage tenants don't do that. And there is recourse, unlike in the apartment community. If, right now, if you don't pay your rent in an apartment, there's no eviction ability. There's no ability, or if you're in a condo, there's no ability to really foreclose. There's a moratorium on that. And the self-storage, if you think about it, those are exempt from those foreclosure, eviction sort of things. You can always sell the belongings of their storage if you have to. So I like self-storage. We do like multifamily. Multifamily has obviously the benefits of a lot of leverage. We leverage about 48% of our portfolio, so it's a really relatively low leverage. Apartments are doing 75% oftentimes, maybe more, maybe a little bit less, depending on where the market is.
So it seems like a lot of things have changed during the pandemic. Did your investment thesis change overall as terms of what types of properties you were looking for?
Yeah. So as I mentioned before, so Modiv is the vestige of acquiring rich uncles. We actually merged 2 real estate investment trusts together into one. So we inherited a lot of assets. I think the COVID last year was an interesting impact to commercial real estate, right? So if you go back to 2008 with the Lehman crisis or the financial crisis, real estate was hit. Real estate prices fell, commercial real estate prices, I'll set aside residential. Commercial real estate prices fell precipitously, and then they recovered. They fell largely because it was a leverage economic situation. So there was excess leverage, there was a dearth of new refinancing ability available. And so the question became, can I refinance my properties or can I afford the debt, et cetera, et cetera. We didn't have a leverage issue last year. What we had was a more fundamental issue. So if you think about commercial real estate, its primary purpose is to physically co-locate a business with its people. Those people could be their employees or their customers, but it's designed to house them under one roof. And when you have a sort of economically disincented third party, which was a state or local government entity, says you can't physically co-locate because we're going to shelter in place. So we're going to sort of take a light switch and turn off the primary value proposition of your building. And we're not going to tell you for how long we're going to do this for. It really called into question, how do I value my real estate? As a tenant paying rent, how much do I really want to pay if I can't use this, right? And then for a buyer or seller of the real estate, it's like, well, how do I value what the real income stream of this property is? And so we went through this really sort of nebulous period of time. At the same time, banks were sort of frozen up because they were doing PPP loans. And it's like, okay, the transaction market sort of ground to halt. This is when most valuation pricing in real estate is done by comps, sales comps. And so when there are no sales, pricing they use a different valuation methodology. And they look at the valuation of what would happen if you went dark and you had to relet it, or what is the replacement value based on the materials that you put in. And those values are typically very different and oftentimes lower than they are based on transactions. So we had this period of time last year where we had a large degree of uncertainty, for about 6 months of uncertainty. And if you make the parallels to 2008, we saw commercial real estate prices fall, but they lagged public REITs. So public REITs fell right away, and then private commercial real estate fell a little longer. Then public REITs rebounded, and then commercial real estate rebounded afterwards. So there was a lag. We kind of saw the same here. Like for instance, we chose to have Cushman value our portfolio, scrub out any sort of risk in it, and it was a downdraft last year, and we've recovered a good chunk of that, and I think we'll have it fully recovered in no time. And so during the course of last year, I really, because we had inherited properties, looked for those tenants or those properties that we said aren't really durable, right? Maybe they asked for rent relief, and I don't fault anyone for asking for rent relief. It was just, you put your hand on ask. We didn't necessarily provide it. But what was the quality or the strength of that tenant? And so what we ended up doing was selling some of what I deemed non-durable or non-essential retail assets that I don't think would survive again if we had another sort of COVID shelter-in-place mandate. And so we were a net seller of those assets at the same time that the 1031 market was, individual buyers were paying even lower and lower cap rates for those types of assets. So we thought we can't find the ones we'd like to buy, so therefore we were a net seller and we sold those off. As a go-forward basis, I think we like our portfolio right now. It's solid. We've collected 100% of all our rents. Our tenants are renewing, so we feel good about that nature. But buying in this market, you have to be very careful, right? Because there's a lot of money chasing assets, and I think pricing is really important because so often I see people say, "Well, I can afford this property now because I got a low interest rate." But almost every form of financing, unless it's like a really long-term thing, requires you to refinance it. And if you're going to refinance in 5 years or 10 years, I'm willing to bet $1 that your interest rate is going to be higher than it is today.
That kind of leads into the next question about acquisitions. So what is like your favorite type of acquisition? What is like the ideal acquisition for Modiv look like?
Yeah, we just closed one, I think yesterday. We closed on a Raising Cane's. So that's a quick service restaurant. If you're familiar with Raising Cane's, it's a chicken purveyor, second in demand to Chick-fil-A. They're complementary in terms of things. So we bought one in San Antonio. We found this off market. It was by an insurance company who owned this in their portfolio. We got it off market. We paid about a 6.25 cap for it, cap rate. The market for these are probably 575, 580, 560. And so we talked, it had a shorter term lease, so it has 5 years left on it, but we talked to Raising Cane's, the real estate department, they actually had tried to buy it back, which to us is a good sign. That means they like the location if they're willing to try to buy it back. And their sales are above average. So to us, an off-market deal where we can buy it at an attractive cap rate, that there's automatic compression day one, that we have good quality real estate. So main location, the dirt's good, people like it. There's a reuse possibility if the tenant for some reason didn't renew. That's an example of something we really like. We've probably put LOIs or letters of intent out on over 70, actually probably $90 million of real estate year to date. And we've ended up closing on very few of them because we're selective. What we're seeing is we're putting in a competitive cap rate that we think is competitive. And then people are just chasing these things ever lower and lower. We're pretty disciplined. We're talking about AFFO earlier. So we manage a $400 million portfolio of real estate. We have over 7,500 investors, and we do it with a team of 19 people. We do that because we have technology. Day-to-day property accounting and property management, we outsource to Colliers. So Colliers is a nationally recognized shop like CBRE or Grubb & Ellis or Cushman. And they put all the transaction data of these assets, which are pretty straightforward, into Yardi. So we use Yardi as our backbone accounting system, and our accounting team processes it. I bring this up because we're able to leverage a lot of technology to manage these assets. And so the key here is when we buy an asset, we're modeling to see, is it accretive? If we buy this property, does it add pennies to the share price, to the AFFO? We just don't buy a property because we love the property, right? Because so often people fall in love with real estate and they don't fall in love with the finance or the economics of real estate. So we make sure that every property we buy is accretive, so we're not buying something that's dilutive or that we won't be able to, it doesn't make sense when we look at it 2 years later. We want to make sure that everything we're buying is going to increase in value and that we have a positive spread between the relative rates today as well as the refinancing rates later.
I want to bring in a couple of questions that we've gotten from the audience. Jonathan asks, for a novice investor in REITs, it seems like investing in Modiv is riskier than investing in larger publicly traded REITs and only open to accredited investors. What are Modiv's advantages over larger REITs besides the 12 to 13 dividend payments per year?
Look, I think any form of real estate, actually any form of investment comes with relative risk, right? So I think there is no such thing as a risk-free investment, particularly when you're looking at equity. So when you're buying shares of Modiv, you're buying into the equity of the company. So we have $400 million of real estate. We have $200 million of debt. There's $200 million of equity, and that's the component. That's the same as you're buying into a publicly traded REIT. I think that the biggest differences of the two is, one is, as I mentioned before, we don't have the same price volatility that a publicly traded does. We also don't have the same liquidity. So you can go and sell your shares at any given day on the stock market. There is worth to that. If someone wants daily liquidity, then I think you shouldn't be in any private real estate vehicle because real estate by its nature is illiquid. That said, we do provide monthly liquidity. So we have the ability, assuming that we balance purchases with redemptions, but each month we redeem requests that people get in. So you can come in on any given day. You can redeem. So a lot of the crowdfunding real estate opportunities there they don't have any known liquidity. They'll have liquidity in 5 years or whenever they go full cycle. We're a long-term buy and hold strategy, so we're not looking to flip assets. But we are looking to pay dividends. We do pay 13 dividends. That 13th dividend is unique. A couple companies pay monthly dividends. We pay a 13th dividend, and how it's designed not unlike how you would think about an insurance rebate that you might get from your auto insurance member. So if we exceed that AFFO target for the year that we set for ourselves, and we're going to distribute the excess to our shareholders. But it's not just a special dividend payment like a REIT does, where everyone gets it at the end of the year. Ours is designed that if you owned more shares and you held them for a longer period of time, you get more of the dividend. So it's calculated on a daily basis. And so if you held shares for the entire year, you're going to get 365 days of that rate. So I think on the margin, we have more liquidity risk. And I think that's important. We have less price risk. The asset quality is very similar. So you're going to see we have over 70% investment grade on our leases. So what we're buying is the same as the net lease publicly traded REITs. Many times we find ourselves at the table alongside STORE or REIT or these other ones when we're buying assets because we're buying the same institutional quality assets.
So another thing that I noticed that you guys have instituted to try to set yourself apart from others in the crowdfunding space is you hold quarterly conference calls, and you're really setting yourself up as a traditional publicly traded REIT. I found it interesting on your last call, you mentioned that you see a liquidity event, possibly an IPO over the next 24 to 48 months. Talk to me about why an IPO, because we talked a lot about why being private has its advantages. What would being public have advantage over private for you guys?
Yeah, absolutely. I think the quarterly earnings call that you've so I've taken a REIT public and then sold it. I joined a public REIT and then took it private to a private equity firm. I've been on the public side for a while. I think I tried to bring all those aspects into Modiv. So, for example, we're fully internalized. So I, as an employee, or all the team, are members of the REIT. We work for the REIT. We're not an external party. There are no fees being charged. So there are no acquisition fees. There are no disposition fees. There's no promoted interest or carried interest. We have the normal cost of a company. So we have the G&A and the normal expenses like any publicly traded company does, or any sort of company does. And we manage those tightly. That's why our focus is on AFFO. We have directors that these are all people I had worked with in the past that have true, they've been CEOs of publicly traded REITs. They're all really best in class board of directors, because ultimately, a lot of people forget about this. As a shareholder of a company, the shareholders are electing the directors. You want to make sure you have good board of directors, because then they are in turn engaging the management team and making sure that they're doing it. So the duty falls on the directors to oversee or steward the well-being of that company. So good corporate governance to me is key. Transparency is a key, and that's why the earnings call came in. And so we're running it just like we are a public filing company. So we'll do Qs and Ks, and we'll do 8Ks, and we'll do everything just like a publicly filed company. We just aren't listed. Eventually, we think a listing makes sense. And you raise a good question. Why? If I just made the argument that private real estate is complementary to public real estate, which I do believe, then why would you even go public? We're unique in the sense that our investors also own the real estate crowdfunding platform. So they own the technology. They own this. We raised all this money through our own technology. They own that. So if I go to CrowdStreet and I invest in a deal, I own that deal, but I don't own CrowdStreet. If I go to Fundrise and I buy that into that REIT, I own that REIT, but I don't own Fundrise. When you go to Modiv, you own Modiv and you own the real estate. And you also own the prop tech and fintech investments we do. Why would you go listing then? Well, Cushman values your real estate. When I mentioned before about our NAV, each quarter we get our real estate valued. We don't value the technology. Accounting rules just don't allow for it. So we're not going out and getting independent appraisals of all the technology and all the sort of critical mass we're building. The only real way to unlock that value is to have it on a public listing. So as we continue to, and I'd love to talk to you about what I think about the crowdfunding space is and how it's evolving, but we have all this technology, we have all this sort of stuff that's not getting valued in our NAV, but it's valuable. And we view that probably the only way to get that valued is to eventually list, and so that the public market can decipher it. And they'll, for instance, Apple's accounting will only give you a certain value of its assets, but people pay far more for Apple because they believe the intrinsic value of what they're creating. And you would never find that out in a private company if Apple were private. It happens because they're public and there's these discerning investors buying and selling at the same time.
So what real estate trends are you most excited about right now? It seems like there's a lot of different things happening.
You know, the most exciting to me right now is the convergence of technology and real estate. Real estate is one of the sort of least or we're the slowest adopters of technology. And you ask yourself why. It's a huge asset class, trillions of dollars in size globally in the asset class. And we've had technology in financial services for 20 years, right? And now we're talking about prop tech and fintech in a way that's sort of, novel or new for real estate. But real estate has gotten away from having technology just because it's a very physical asset. It's very conducive to people. You need people. It's on the ground, so to speak. And so you didn't have to have it. But I think technology is really going to accelerate the demand for real estate. And so that's where we think it's interesting. If you actually think about real estate crowdfunding as a technology play, I liken it to the discount brokerage environment. If you go back to May 1st of 1975, that's when stock commissions were deregulated. Before that, you were controlling how much you could pay for stock commission. Charles Schwab launched the company shortly thereafter. And from the late 70s to the mid 80s, you saw a bunch of discount brokerage firms shop. There was Scottrade and Ameritrade and E-Trade and you name it. And so what happened is you saw them emerge. So low barriers to entry, but high barriers to success. Then you start to see them go public and then consolidate. And now discounted brokerage and the use of technology in the financial services is so accepted that we don't think anything of it. We're at the early stages of that with real estate. I think as more crowdfunding gets adapted, more players will see consolidation in the space, we'll see listing events of the space, we'll start to see real estate become more and more like the traditional financial services we have. And I think that's a positive for investors and a positive for capital markets, because more investors come to the space, that provides more demand for the asset class, and it's sort of self-fulfilling prophecy. So that's where I think is the most exciting.
You mentioned that you think consolidation needs to happen in the space, and I know you guys made a couple of deals. What do you mean exactly by consolidation? You're talking about the REITs consolidating or more of the platforms? How does that look, and how will that benefit investors?
I think the answer is both. Externally managed portfolios where there's not just a single deal, but like a collection of deals that is externally managed where there's fees getting paid. That means there's a conflict of interest. If I as an investor have to pay someone to manage my assets and they're getting paid an acquisition fee or disposition fee, I'm getting all these unnecessary fees that public REITs have shown us we don't need, right? We don't need to have excessive fees in our structures to own good real estate. And in fact, we shouldn't have excess fees in our structures. So any sort of orphaned or zombie external vehicle out there, I think should be consolidated. And that can be someone like us consolidating, it could be a publicly traded REIT consolidating. There's a lot of choices out there, or it should be sold and disbanded, right? So you should sell the portfolio and break it up. But I think this arcane sort of antiquated structure of charging lots of fees is not, it's acceptable in the mutual fund space because mutual funds can't afford to have employees, so they outsource it, but the fees are really reduced, right? Vanguard led the way in that regard. And so the management fees or the total expense ratio of a mutual fund is very low. But if you look at the externally managed vehicles on the REIT space, they're very high and they don't need to be. So I think there's consolidation in that for purposes of improvement. On the crowdfunding side, as I mentioned before, there's these multiple models. There's a digital syndicate model and the asset aggregator model. Going back to that discount brokerage, if you think about Charles Schwab, as an example, as a discount brokerage. And back in the late 70s, early 80s, you had Fidelity and Vanguard, who were just asset aggregators. Now Schwab offers mutual funds and asset management, and Fidelity and Vanguard offer discount brokerage. And so the models merged, right? And a lot of these shops consolidated players into this as they thought the merging into the models. I think you'll see the convergence of these business models in real estate crowdfunding as we get scale. I mean, crowdfunding real estate volumes have grown about 15% annually. We're well over $1.5 billion of distribution in a given year and collection on these platforms. So it's gaining more traction. As it gains more traction, you have to get more acceptance. And so I think consolidation and scale always benefits the economics, both for the investors of the company as well as the industry overall. So I think that's why we'll see it happen on both fronts.
So let's talk a little bit about the potential for a second COVID event. We're starting to see some of the mask mandates return. The CDC just announced that today. How is that changing your thinking about future investing?
Yeah, I don't think it's changed our way of thinking, but it is reinforced the way we did think. So make sure, so we're primarily buying single tenant long-term leases. So we want to make sure that tenant has long-term viability. So they have good, we look at their financials, we're underwriting them, right? For instance, we've seen some deals about private equity-led sell leasebacks. So this is when a private equity shop will come in, buy a business, and then they'll turn around and sell the asset and lease it back from them to sort of generate cash. Oftentimes we'll look at those balance sheets and they're super highly levered, and you wonder, how are they going to survive if they don't grow themselves out of it, right? So those on the margin, we're like, I don't think we like. We want solid financials by our tenants so that they know that they can pay the rent. We also want to know that this property is important to them, that they just don't care if they have to walk away from it, right? We got burned. We had a 24-hour fitness. So 24-hour fitness, we had one in Las Vegas. 24-hour fitness got hit by COVID. They filed for bankruptcy. They rejected over half of their properties across the nation. Ours got rejected. Now we were managed to sell it to to another REIT and make lemonade out of lemons as best we could. But that was an example of that wasn't critical to them. They could shut it down if they didn't want, conveniently. So when we're looking at office space, it needs to be a headquarters building so that this is where the CEOs and all the ones who are making decisions are going in and they like it, right? It's not like it's a regional office. Or we have several of them that have secure data facilities. So these are government contractors who have secured facilities within their buildings, and they spend hundreds of thousands of dollars to improve these buildings. So it's kind of like you fixing up your house really fancy. If you're renting it, you're going to keep renting it because you want all that stuff that you put into it. So we look for those types of signs. I think also we're just, I don't care so much about the market if that's a mission critical to that tenant, right? So it could be in Missouri and someone would say, well, that's not a primary market. But if it's primary to this tenant and it's core to their business, then it's primary to them. And so therefore I can live with that, right? That being said, I'd love to get primary markets if I can. The last thing we look at is just good real estate. If we have to, in the worst case scenario that the tenant leaves and that business goes on, how do we repurpose this real estate? Can we scrape it and put something new? Can we find, does the building have a good footprint so we can put a new tenant in? We think about all those types of things. So if COVID happens again, God forbid, or well, it's happening, I guess, but if the shelter in place mandates come back, which I don't think is that unreasonable to expect, it was a mechanism that worked. I likened it to the aerial bombings in World War II, where in England, people would just go into the tunnel. And every time there was bombings, they would go down into the tunnels, right? And so the tube. And so that was a safe measure. And I think shelter in place is a safe measure that we will see governments enact. And so I think everyone will be a little bit more wise the next time it happens. So I think tenants will be a bit quicker to ask for something, particularly if they're around on lease in a renewal, they have leverage. I think landlords are going to be a lot more wise about it.
So you guys are, as you mentioned, the triple net lease space. You like that business model because it just provides a steady cash flow. Is there a company that you emulate? Is that why you are in that space? Or is there an investor? What drew you to that space, and what kind of public company, private company do you guys want to aspire to be like?
So I look at this as an amalgamation, right? Because as I started the conversation, we're a real estate investment manager, we're a real estate crowdfunding company, we're a technology investor, and we're also a net lease REIT. So we have a few proxies to look at, as it relates to the net lease REIT space, and having, listed a net lease REIT and sold it. I like Realty Income. I think they're a great model. They have a lot, their history is great. Their management team is solid. There are a lot of good REITs. I know a lot of the executives of all of those REITs. There's a lot of good REITs. I think they're probably the easiest one to example. They're the largest. They're not too far down the street from us here in Southern California. So on that front, I think they're a worthy role model. From an asset aggregator standpoint, we've been called sort of the vanguard of real estate. I find only compliment in that description. I think John Bogle was a genius in what he did. It's a mutually owned sort of structure in a way. Ours in effect is our shareholders own all of this enterprise. And I believe, honestly, to get exposure to the asset class, and I think net lease is conducive to that because it's income producing and it provides sort of long-term leases, but it has CPI elements to it. I think it's conducive to that. I think exposure to the asset class is absolutely the best way to go for real estate, but you need to reduce the cost of ownership. And so I think Vanguard is an emulation on that front. From the technology side, and from the, I think there's a lot of examples. None of them are directly applicable, but I think it's the smart use of technology. For instance, we use off-the-shelf technology as well as proprietary. And I think, we kind of built this, the fact that we have a $400 million REIT, 7,500 investors and 19 employees, it's a clean sheet approach. So we said, how do we build this right? And so I built a team to be very similar to a hedge fund or private equity. We have very seasoned, if you look at the bios of our executive team, very seasoned, lots of experience. And by having very capable people who are all, by the way, incentive on the long term with that AFFO growth, they only earn money if we do well for the shareholders. And that allows us to manage with less people because they're very capable. It's very much like you see in a private equity or hedge fund model. So we try to emulate best practices across a lot of different things, but those companies come to mind for sure.
Wanted to ask you about ESG issues, your thoughts about climate change. Maybe that's how that's affecting how you select properties.
It's not, to be honest, and I don't mean to be callous about it. I think we're right now we have so much capital chasing the real estate markets and so many different constituents that ESG qualifiers, though they're nice to have, are hard to fit in. I'd say on top of that, if you look at the biggest vein of ESG within as it relates to real estate, it's been sort of the LEED certification, right? So LEED certification buildings have been around for a good while. I've worked in a number of them. I've owned some in the past. They tend to be office buildings on the margin. And they tend to be sort of custom developments, right? You can retrofit buildings, stuff like that. They're always nice to have. I think, buildings that are conducive to solar are an interesting way to think about it. So as solar technology the panels construction gets even more efficient, a lot of, your Southwestern assets, which have large roofs, make it very easy to think about in terms of doing that. But I think overall right now, we're seeing ESG is not a primary driver for at least real estate acquisitions of income producing assets. I think it probably is more prevalent in the development space. Is they're sort of thinking about how they develop it with consciousness footprint.
Now, earlier you talked about you like the self-storage space and you like the multifamily space. Now, those are not triple net, although you can, I know WP Carey does some triple net for self-storage. Do you see that as fitting in the business model, those type of properties going more completely diversified, or would you just stick with triple net?
So we're an experienced real estate investment management team. So we have capabilities. The team has done different asset classes. If you look at when I mentioned earlier about NCREIF and these sort of pension and institutional money, they'll invest in, a lot of them are REIT structures. They're true private REITs, so they're not doing any public filings, but they elect a REIT status, which is obviously to avoid double taxation. And they're commingled funds. BlackRock had one, Principal has one, Prudential has one, ING Clarion. And there's a lot of these large, tens of billions of dollar sizes who've been around for 30 or 40 years. And a lot of the traditional retail investors don't know about these vehicles, but they invest in sort of diversified food groups, right? So they'll have office, industrial, retail, apartments, self-storage. They'll have all these types in it. And I liken it to an engine. If I have an engine has got these rotating cylinders, they're firing at different times. So where in retail might be firing, your office may be out of favor, and vice versa, right? You think about publicly traded REITs have gotten to be sector focused, and that is really an interesting history to it. Almost all the REITs started out as multi-asset class, right? And over time, the sell side analysts said, "Well, sell off this stuff because it's too hard to analyze." And the other part was that the modern REIT era, and Green Street, where I worked at, was a big factor in this. Started catering its research to REIT portfolio managers, like the Cohen and Steers of the world, right? So they're actively managed and they're picking stocks. If I'm picking stocks, I want to pick the best apartment shop and the best net lease shop, and I don't want them to have both in their set class, because how do I add value, or how do I just make a pure play? Active real estate stock management is actually a very small segment of the market now. The REIT passive ETFs are a much larger portion of the publicly traded REIT space. And so the sector narrowness is really a public event. So I think a diversified income portfolio ideally has cylinders that fire all, right? We have no designs today to go into any of those asset classes. And if we did, I'm not sure that it would be in this vehicle or it would be in a sister vehicle, to be quite honest with you. It really demands by the demands of the investors. But the fact that you have income producing assets and they're always firing in all the cylinders only enhances the value of the portfolio, and it gives you diversification. I liken back to last year, Simon Malls, right? Large company, great assets. Malls were really hit by COVID, right? And they're investing in some of their Brooks Brothers and some of their other tenants. I'm sure David Simon would have loved to own 100,000 apartments, because he would have had rent coming in to offset the things. But the way the public markets are working, he couldn't do that. But if you look at high net worth or sort of sovereign wealth funds, they do mix them together because they throw off income at different times.
Yeah, that is a very good point. One last question from the audience. King Remy wants to know, for a potentially new Modiv investor, the $1,000 initial investment should yield what percentage of monthly return at this point post-COVID?
The dividend can and will increase over time. That's outside of the 13th dividend. So we expect the dividend to, strengthen over time. It's all a fraction of the AFFO. The $1,000 is the minimum. We recently filed for Reg A plus status. So we'll be converting to a Reg A offering near term. And so that will allow us to, once again, take non-accredited investors. Most of our investors are actually non-accredited. We went accredited for a short period of time for some specific reasons, which we'll announce in the near future. Yeah.
All right. Matt, do you have any last questions as we get close to wrapping up?
I probably have 1,000 questions, but I always take too long. I do just want to thank Aaron for his time. He's been just so generous with me. Like I said, we did a crowdfunding review of them, and he, gave me all the information I needed. And then his team has been great. It's been just an interesting company to see. I've followed a lot of these crowdfunding companies, and I really think that they stand out just as their investor focus. I don't even think he mentioned it as much as he should have on this time of how investor focused they are. So I guess in my last question will be, why do you want to be so investor focused? A lot of, crowdfunding companies are just in it for the money, it seems, but you guys seem to be in it for the average person.
Yeah. I mean, like if I were doing it from my own pocket, there'd be a lot of other ways to go make a lot of money. My dad was an electrician. My mother worked in an office. I was the first person to go to college. I got deep blue collar roots. I think about the people who, sophisticated or not, wealthy or not, they all require someone to work for them, right? Service is so hard to find this day and age, and in dedication to a craft. And so that's kind of how I'm wired. And so I wanted to build and work for a company that really put the investor first. And so to us, that means eliminating unnecessary fees, being very candid. We're not always going to tell you everything's pretty if it's not. We're not going to lie to you. We're going to be very honest. So we're going to be very transparent. And if you want access to information, we're going to do our best to give it to you. We're not going to be all things to all people, right? I'm not going to promise you an inflated return or something that I don't think can be realistic, but I'm going to make sure I work really hard every day, and the whole team does. And I think that's about putting investor first, because that investor could be my mother, it could be my sister, it could be me. We could be any of us out there who really just want to be able to own commercial real estate. And we don't want to deal with tenants. We don't want to deal with trash. We don't want to deal with toilets. We just want to be able to own it. And we have a day job, or we have a family. We have other things we want to work on. We need to make sure that our vendors, the people that we're giving our hard-earned money to, are doing a really good job for us. Not for them, not for the vendor, not for the manager, but for me, the investor. And so that's just philosophically how I am. And that's the only kind of company I will build or work for.